Before the opening bell, a rumor hit Wall Street like a gunshot. Lehman Brothers was finished. By lunchtime, a 158-year-old financial giant was gone, and more than $600 billion in assets were headed to bankruptcy court. But the real horror wasn't the filing. It was what happened next. Credit snapped, markets panicked. The shockwave jumped from trading floors to ordinary lives. This was not just a company dying, it was a chain reaction. So what did Lehman do to become the match that lit the global crisis? Lehman wasn't supposed to fail in modern America. It had survived wars, depressions, and generations of chaos. At the center stood CEO Richard Fuld, aggressive, stubborn, and publicly unbreakable. He sold one message: Lehman was strong, disciplined, built to win. Investors wanted that story. Ratings agencies helped protect it. To the public, Lehman looked like a fortress, and that reputation became the shield that let danger grow inside. In the early 2000s, Lehman chased the hottest profit machine on earth: housing. The firm poured money into mortgages, real estate deals, and securities tied to rising home prices. Quarter after quarter, profits looked clean. Bonuses grew. Confidence turned into arrogance. Inside the building, the pressure was simple: grow faster, borrow more, dominate. The higher Lehman climbed, the harder it became to admit what those profits were built on. Here's the engine that made the money, and the trap. Lehman used massive leverage, borrowed funds to hold long-term mortgage assets. When markets were calm, leverage made returns look brilliant. When markets turned, leverage became a noose. To appear safer, Lehman used an accounting maneuver known as Repo 105, temporarily moving debt off the balance sheet near reporting dates. On paper, risk looked smaller. In reality, the firm was more fragile than it admitted, and the moment confidence cracked, that fragility would become fatal. By 2007, the warnings were no longer subtle. Mortgage defaults climbed, housing cooled, liquidity began to dry up. Other institutions reduced exposure. Competitors quietly stepped back from the edge. Inside Lehman, risk concerns surfaced, but leadership refused to blink. Selling assets would lock in losses and signal weakness, and Richard Fuld would not accept weakness. So the firm held, borrowed, and insisted the storm would pass. That denial turned warnings into a countdown. September 2008. The market stopped believing. Buyers studied Lehman's books and walked away. Counterparties demanded cash. Funding evaporated in days, then in hours. Lehman begged for a rescue, but this time the U.S. government would not deliver a full bailout. With no buyer and no lifeline, Lehman collapsed, and fear spread faster than facts. Because once one pillar falls, everyone starts questioning the rest. After Lehman, the system seized. Banks stopped lending. Businesses lost credit lines. Markets sank worldwide. Then the human cost arrived. Layoffs, foreclosures, families watching savings and stability disappear. Investigations later highlighted extreme risk-taking, misleading balance sheet optics, and a culture that rewarded short-term wins over survival. And the public learned the brutal truth. When trust is traded like a product, the crash doesn't stay on Wall Street. It reaches everyone, and it keeps spreading. Lehman did not collapse because of one bad week. It collapsed because of a decision path, leverage, denial, and leadership that refused to retreat. A respected name became a mask. Complexity hid danger. Confidence replaced caution. And when confidence died, the bill landed on millions of lives that never signed those trades. If you want to understand how systems break and where the billions disappear, subscribe now. Because this is not a one-off story. More investigations coming.